Are you considering Roth conversions for your traditional IRA? We're going to dig in deep today on episode 81 of the Atlas Annuity Podcast. Hi, everyone. This is Marty Becker, owner and founder of Atlas Financial Strategies in St. Louis, Missouri, where we specialize in safe money retirement strategies. In today's episode, we're going to talk about Roth conversion strategies. Now, I had just gotten back from what's called the Ed Slott IRA retirement seminar. It's a really advanced class on traditional IRAs and the best way to deal with them in retirement. So, we're going to go through some of the things that I learned because at the end of the day, it was a 2-day class from like 8 to 5 both days. And I can say we spent pretty much the entire first day just talking about Roth IRAs. So I want to set the table for this episode on what to expect. Okay. So this is just going to be a 30,000 foot view of how all this is going to work. There are some other things to take into consideration when we're looking at Roth conversions that I'm not going into in this particular episode. Things like how a Roth conversion could affect your IRMA and the fact that after you turn 73 and you hit your RMD age, you still have to take RMDs, and a Roth conversion does not count towards that. So that kind of stuff isn't factored in because I was trying to keep this very high level. And also, I want you to understand this is not tax advice, okay? This is not me telling you to do Roth conversions. I'm merely going to explain some benefits of the Roth conversions and having Roth money. So you always want to speak with your personal tax professional before you do anything. Okay. Don't listen to some guy on YouTube like me. Talk to your personal tax advisor before implementing a strategy like this. One of the biggest objections that I hear when this topic is brought up is that, well, if I do the Roth conversion, I'm going to have to pay taxes on that money. Yes, you will. Okay. You have been taking a tax deferral and for however many years, that's not a deduction. It's a deferral, meaning the government is going to get their money at some point. And if you're going to convert that money, historically, there's never really been a better time than right now. Okay. Because when basically the American people were tricked into paying taxes back in 1913 with the creation of the Federal Reserve, the original promise was income tax would never go above 2%. Well, it didn't take long to figure out they were lying. And this was an enormous ruse from a private bank that got passed into federal law. So if we're looking at this chart here, we can see that historically, since income taxes have been implemented, we're at a pretty low time throughout history. When you go back to like the 1950s, the top tax bracket was over 90%. In fact, this is what drove Ronald Reagan into politics. When he was making movies back in the 1950s, him and John Wayne have been on record saying that they would not make more than one movie per year because anything they made basically above $100,000, the government was going to steal 90% of it. So they limited how much work they did. And it was these tax rates that actually drove Ronald Reagan to running for governor in California and then ultimately becoming a 2-term president in the 80s. And you can see the tax brackets dramatically dropped when he was president. So now, historically, we're in a pretty low tax bracket for you to take advantage of these Roth conversions. Now, again, we're not going to be looking at like income plays or anything. Let's just go to, we're looking at leaving money behind. The biggest advantage right now with the Roth IRA is being able to take advantage of a law, or I should say a provision that was changed with the Secure Act, because the stretch IRA was lost when Congress passed the original Secure Act. I think that was back in 2020, because your beneficiaries can no longer take advantage of that stretch IRA provision, meaning they can take the withdrawals. If you die, leave them a traditional IRA. They used to be able to take withdrawals based on their lifetime expectancy. After the Secure Act was passed, that stretch IRA provision was taken out of there. Now, the entire non-spousal inherited IRA, all the money must be depleted by the end of the 10th year after the original owner has passed away. So if you die, God forbid, if you die in August of 2025, all that money has to be taken out of your IRA if it's passed to a non-spouse. It has to be taken out by the end of 2035, so December 31st of 2035. So this could present a huge problem for your beneficiaries when you leave them a bunch of tax deferred money. So we're going to take a look at an example of someone who has $1 million in a traditional IRA and they don't really need it for income. They're not necessarily keeping it just to pass it on, but they don't really need it either. So the chance of it being passed on is relatively high. So let's just take a look at a married couple. Let's just say they're age 60. They have $150,000 in retirement income. And let's say that's from Social Security, a pension, rental real estate, qualified dividends from non-qualified brokerage account. They have $150,000 in income. Standard deduction, I'm not looking at state taxes or anything like that, but just a standard federal reduction of $30,000. Their federal income tax liability every year, based on $150,000 of income, would be just over $16,000 per year. So let's say they want to start converting their traditional IRA in a strategic manner over a 20-year period. So they would be adding an additional $50,000 of income to their tax liability, which would raise their taxes every year by $11,000 to just over $27,000 per year. Now, just to keep things simple, okay, let's just say that, hey, we don't want to increase the tax liability on the traditional IRA, so we're just keeping it in cash. We're making zero money on it because we want to be able to convert 50,000 for the next 20 years and just have it done and over with. So that IRA is no longer growing, but the Roth IRA is growing at 4%. So every year we're putting $50,000 into some sort of account or product that's just giving them 4% every single year. So 20 years to convert that $1 million. Let's say, unfortunately, you just get done converting and you die at 80 years old right after you made your last conversion. Okay. So at that point, your beneficiaries, a non-spousal beneficiary, that's what we're looking at here, that non-spousal beneficiary would inherit just over $1.5 million in Roth IRA money, so completely tax-free to them. But because you did the conversions, the 10-year rule still applies to Roth IRAs. But that money can continue to grow tax-free for the next 10 years because it doesn't have to be taken out until the end of the 10th year after the original owner's passing. So let's just say that 1.5 million continued to grow at 4%, completely tax-free. Okay, now your kids or whoever you decide to leave that money to, now that money that you passed on to them has grown to almost 2.3 million. And at the end of the 10th year, they can take it out completely tax-free. That costs you about $220,000 in taxes to do that conversion process over a 20-year period. Now, let's go back to the scenario where you don't do anything and you just let your traditional IRA continue to grow at 4%, but you still pass away at 80 years old. Now, your beneficiaries will inherit about 2.2 million, so about 700,000 then if you were doing the conversions. However, this money is fully taxable to them. And again, it must be depleted by the end of the 10th year after your passing. So this creates a huge tax problem for your beneficiaries, your non-spousal beneficiaries. So now let's say, okay, your kids are making about the same that you were making in retirement, so 150,000 a year. They get this $2.2 million fully taxable inheritance and they go, holy crap, we have 10 years to get all this money out and pay the taxes. This is a huge problem. So the other liberty I'm taking here is we're just going to stop the growth on that 2.2 million they inherited in taxable money because all it's doing is creating a bigger tax problem for them. So let's just say they're going to take an even withdrawal of 220,000 for the next 10 years. But what that does is that adds $220,000 in fully taxable income on top of their 150 that they're making. So now their income taxes, their federal income taxes go up to almost $68,000 per year, or just over 67. So they have to pay an additional 51,000 just in federal income taxes. What was the end result of this scenario? It was pretty eye-opening actually when I was running these numbers. So your beneficiaries could have ended up with $2.92 million for the cost of 220,000 in taxes over a 20-year period if you were implementing the Roth conversions very strategically. Instead, for the person who did not do the Roth conversions and just let their IRA continue to grow, they ended up with 1.68 million after they paid all the taxes. Only now they paid over a half a million over that 10-year period. So not only did that cost your legacy to your children and grandchildren about 1.25 million in less money in their pocket, you also ended up handing the government an additional $300,000 of the money that you worked your entire life for. Uncle Sam is going to get his money one way or the other. So the question is, can we come up with a better strategy? And each strategy is going to be individual for each case that I look at. Okay. So maybe if you don't want to pay the extra 11,000 every year for doing those conversions in this scenario, maybe make a deal with your beneficiaries to pay the taxes for you while you're doing the conversions. Because if someone made me the offer of, hey, if you cover the taxes of 11,000, so basically you're handing me 11 grand per year, okay, here you go, dad. Here you go, mom. I'm giving you 11,000 based on this agreement here. And eventually I'm going to end up with almost $3 million. Okay, that's a good deal because that comes out to about a 23% return on your kids' money if they're covering the taxes for you. Now, it's probably going to be a little less than that because the calculations, and they got to wait an additional 10 years to get the full 2.92 million. But let's say it's 18% if I really dug into the math on what it would be. That's a hell of a return. And we can do it with no risk. So we can house that money, we can protect it and do internal Roth conversions using FIAs or MIGAs, or maybe we're setting this up for future income for you later in retirement. I don't know. There's a million different scenarios that we could look at. But the rhetorical question that I always like to ask myself when I'm recording these things is, okay, what's the point? What are you trying to get across here? Number one, take advantage of these historic low rates. One point I do want to make is please don't call me and ask me to do Roth calculations for you because the answer is always going to be no. Not because I'm trying to be a jerk and not because I'm afraid to do the work, but that is giving tax advice. I do not give tax advice. What I do is I provide the products for you to do these Roth conversions so you can protect the money from risk, market fluctuations, and we can do it with no fees. And we can do that by using, again, fixed indexed annuities. We could do it with a multi-year guaranteed annuity where we know we're going to get a specific rate of return every year. And again, maybe we're looking at income annuities for those of you who are wishing to set up future tax-free income in retirement. We can come up with a strategy for that. The main point is I'm not here to give you advice on when or how much you should do for Roth conversions. I'm here to provide a safe haven for your money while you're completing these conversions to get all the benefits that we just talked about throughout this video. Now, if you're new to annuities and you really have no clue what I'm talking about, my suggestion would be to go to my website and watch my video series 20% More Spendable Income in Retirement. You can find that just by going to atlasannuity.com and clicking on the video section, and you'll see a link to start that video. If you've researched annuities and you think that it's probably going to be a good fit for you, okay, then you need someone who knows what they're doing in the world of annuities. That is my wheelhouse. Okay. So at that point, what you'd want to do is book a short Zoom call with me by going to atlasannuity.com. That takes you directly to my calendar page, or click the schedule a call button in the top right corner of any page of my website. And we need to get your questions answered. We need to figure out if there is a strategy for Roth conversions. We need to figure out, okay, do we need guaranteed income to build a foundation to make sure even if you run out of money, you're never going to run out of income? That is what we do here at Atlas. Okay. Again, I want to provide this information, but I also have to be careful that I'm not coming across as giving tax advice or investment advice. So if you're finding this information helpful, do us a favor. Subscribe to the podcast, subscribe to the YouTube channel, give us a thumbs up, give us a comment. If you think there's someone that could benefit from hearing this type of information, share it, share a link, because we certainly appreciate you watching and engaging with us over here. And again, I always want to say thank you. I know your time is valuable, and there's thousands of other people that you could be listening to. So I want to thank you for listening to episode 81 of the Atlas Annuity Podcast. Again, my name is Marty Becker, wishing you all the best in your financial education. We'll catch you in the next episode.